Hello and good morning, listeners. Welcome back to Almus Market Mornings with Shikhar Garg, and we continue our journey with a low activity market as the participants decide to take breather with no major data update this week. Now, on the other hand, yes, we have seen some bit of movement in the dollar against the majors, and overnight it has been a bit weaker, but not significant enough. It's the Japanese equity markets, though, which are having some good rally after being favored by the market participants and also being endorsed by Mr. Buffet himself. So, Japanese equity markets have seen good returns on the year to date basis, but it's the macro front which is giving some slight indications on which further probing is required. It's the retail demand. I mean, it is showing some sort of a fatigue in the last quarter of the fiscal year. Now, JK, I'd like to know what do you think of these low activity markets, and are we actually seeing some sort of a fatigue for the economies to slow ahead?
Uh, Actually, we this low level of activity is also due to the fact that we don't have a frontline economic data from major economies. We will have some numbers next week from US on the GDP and PCE core inflation, but now all other data mostly are second tier. And barring some numbers from Europe and UK, which will be of interest to the markets, but they definitely are not the guide to how the various markets move, particularly on the stocks and the currency. In fact, yesterday we had the first signs of German economy slowing. The zoo indicator showed that it has fallen in Germany for last month, and it was say from from 13 to 4.1, and well below the anticipated level of 15.1. And this suggests that there is a considerable improvement that in the economy that is like unlikely over the next 6 months. Even the European Eurozone zero economic sentiment also dipped from 10 to 6.4, underperforming the expected 11.2. So there is a sense that the people who have been surveyed, they feel that high interest rates and the unrelenting input costs are actually continuing to have their impact, and going forward it can have some impact on the growth. In fact, IMF forecasts on the growth of major economies shows that it's only the UK and German economies which are going to actually contract in this year. So it's something to take note of. Not surprising that the euro is also not making much of a headway about above 1.10. Just for a perspective, we hit 1.10 about 3 weeks back. We had a retest, and both the times it has been unable to hold above that. But we will see. It's an evolving situation because we need more data to see whether dollar is actually bottomed out and some rally is on the cards. On the non-US economies, UK employment report was a big upside surprise, and the wages were rising faster than anticipated, in a move that the economist judge may tip the Bank of England towards a further rise. Till last week, there was some doubt that they could go for a pause as well, but now this is actually become more decisive. Actual employment has also risen much more than expected. Important thing to note about UK is that the UK pay lags behind inflation, which is prompting many strike actions in various sectors. That means that wages will be rising further and put MPC on a more hawkish course. Not surprising, the yields on UK gilts and the UK pound rose strongly after the data. In fact, the yields have taken cues across markets yesterday. The Australian Central Bank's minutes was hawkish. They indicated they will not rule out another rate hike next month. Then the UK employment data further added to the yields going up across the various countries' bonds. ZU surveys, of course, put it on a downward correction. Again, in US session, we had the familiar voice of Bullard's hawkish statements. And he's saying that the market's expectation of a recession in 6 months, pointing to the fact that labor market seems very, very strong. So the expectation of recession is very low, according to him. And the conventional wisdom, he says, is that if you have a strong labor market that feeds into the strong consumption, and which is a big chunk of the economy, it doesn't leak like the moment to be predicting that you have a recession in the second of 2023 is realistic. In fact, while agreeing that tightening cycle may be close to the finish line, Bullard feels that rate will need to rise another 0.5 percentage point. Now that means we are going beyond 5.25, and he is saying that it may go between 5.5 and 5.75. This is the first higher indication from a Fed member, although he is right now not a voting member. But we'll have to see more data and how Fed itself projects in the upcoming meeting on May 3rd. Bostic, who is normally a dovish person, is also said inflation remains too high and there is more work to do by the Fed. But of course, he did say that after one more rate hike, we'll have to pause and sit back and see how the policy is flowing through to the economy. As far as stocks are concerned, we can say that we are in the thick of earnings season, and with mixed reports from various corporate stocks are swinging both ways, but within a range and hardly indicating any strong trend, for which we may have to wait for further indication on inflation growth. Earnings report from European corporate was better, and that reflected in the region's stock market doing better. Overall, better economic news is not helping stocks, as more focus is on monetary policy, whether a recession is really going to hit us later in the year, and how the forward guidance from Fed is going to be on May 3rd. Interestingly, the White House economist Bernstein was saying that the administration is closely tracking developments in the commercial real estate and the many holdings that are held by smaller and mid-sized banks, and there is increasing talk of the real estate related lendings coming under pressure. So that is something that needs to be watched out. Also, there's a news that Janet Yellen will be laying out US economic priorities on China on Thursday's speech. So it's a very sensitive matter. And Chinese yuan, as you know, has been trading on the weaker side relative to other major currencies, despite the fact that their macro numbers yesterday were beating expectations by a mile. So that really says that market is very, very sensitive to what US is going to say about China economic priorities. So all in all, a lot of things in the works. Nothing really major number, concrete or trigger that could give a directional move to any of the markets. But I think we need to watch the developments. I think another directional move is very likely closer to FOMC. I still favor a corrective up move in the dollar because it really looks tired. I mean, it really looks oversold, and the other currencies look a bit tired. On the dollar rupee, the psychological level of 82, or rather, I would say the what was earlier being touted as a big support and broken below it has now been again pierced through to the upside. So the market again comes to the conclusion that we are not getting a directional move on the downside, despite talk of some flows and all that. So we like to see a follow through on the upside. Yesterday we heard, apart from oil and the nationalized banks, foreign banks and the private banks were also on the buying side. I think important resistance is 80 to 25, and a break can actually put some stop loss actions on the cards. So I feel rupee is far from taking a directional move still until we get much chunky inflows in the market. So that's it for now. Have a good day. Thank you.
Okay, JK, that was quite good. And yes, folks, we still await some major kind of development or a trigger to give any sort of directional indication in the markets as of now, because even the earnings season, as JK mentioned, has been giving mixed reports, and None of the economic indicators released this week have been significant enough. It's the FOMC where we can see some bit of uh, clues on where the markets can be headed. But all said and done, as JK mentioned, the ZU indicator released yesterday was seen falling, which can be considered as the first sign of concern for the German economy. And even the Eurozone sales have been declining. So there's some bit of a concern, and probably one of the reasons we have not seen Euro move above 1.1050 and sustain over there. Rather, there's a question quite commonly being referred among the market participants is whether the euro sustains this kind of rally and move further ahead, or does it correct, or does it move in a sideways in the coming days. It's quite interesting to see. Lastly, the expectations of recession is quite low according to one of the Fed governors, Mr. Bullard. So now that's quite interesting of an update, because all the rate hike pause are also being referred to because of the slowing economy and possible impending recession. So it needs to be seen whether the recession is being avoided or what's going to happen. That's it for today, folks. We shall come back again tomorrow with another round of update. Thank you so much for listening.